we've got a very interesting panel today, and the way I'd like to put it is we've got the who's who of impact investing world today at the Cambridge Union. So we're incredibly honored to have all three of our guests at the Union. Rather than sort of doing it the traditional way where I introduce the speakers, I'd like to start slightly differently, where I let the speakers introduce themselves, but perhaps with a mix of how did they get into impact investing? Because that seems to be, we've got a very relevant crowd here of students, so who I'm sure would like to know about careers in impact investing at some point. So with that in mind, perhaps we start with Jyotsna, and then Samir, and then Stewart, we can come on to you guys. How did you sort of end up in this impact investing world? And any introductory remarks?
Sure, thanks. How did I end up in the impact investing world? So 1999 was the first time I traveled into a small town called Jhansi in India, when my mother was working with self-help group women. And honestly, I fell in love with that customer segment. These were women who lived with very minimal access to resources, but genuinely epitomized the meaning of the word entrepreneur. And that spirit is truly infectious. I think it affected me back then. I started off, post my MBA, I joined HSBC as a management trainee, but the bug and the energy that I felt when I met people on the ground stayed on. And sometime in 2011, I felt it was important to move into something that took me closer to this customer segment. I don't think the term impact investing was as popular then, nor was it conceptualized. The only thing that was closest to impact back then, in a commercial sense, was microfinance. And what I really loved was that this segment did not feel like a beneficiary segment to me. It felt like a segment that was willing to fight, was willing to invest in their own growth, was willing to deal with whatever minimal resources they had, and were very enterprising and positive in terms of energy, right? And that's exactly what you see in entrepreneurs when you look to back them. And I felt it was a segment that was worth backing with commercial capital. So when I got introduced to Elevar's founders back then, it just felt right. I moved from Mumbai to Bangalore to start whatever was the next phase of my own entrepreneurial journey. And honestly, just as context, Elevar has been investing in this market and helping build out companies in this space for almost 20 years now. It started with microfinance, which was probably the first established commercial model vis-a-vis this customer segment. And I will say today, as we sit in 2024, it's been a 20-year journey which has been phenomenal. And how? Because that customer segment has grown from what used to be referred to as the bottom of the pyramid to what we think they are today as flourishing entrepreneurial households that are very, very eager to invest and grow and are willing to take on whatever comes by. So I think today Elevar is investing out of its fifth fund. We've invested in both India and Latin America. Our portfolio companies have done business with about 55 million households, and probably business worth $42 billion, which for me is the most exciting because it shows the purchasing power and the spending power and the consumption power and the investment power of this customer segment. So super excited. I think there's 20 more years ahead in a very exciting space. Yep.
Many more than 20. Samir, over to you.
So how did I get involved in this impact investing space? I guess the starting point around where you want to be is often linked to how you've grown up. And I grew up in a family of public service. My father worked for the government. Most of my family worked with government. So the idea of working for government or actually working in public service was always something that was important to me. So actually, I started working in emerging markets with the World Bank, which of course does the bulk of its work in emerging markets. And then for a brief stint after business school, I found myself spending, in fact, in 1 year, 2004, I spent 40 weeks out of 52 in Basel, Switzerland, working with a pharma business. Basel gets boring after 1 week. So I came across a job advert in The Economist for CDC at that time and started working with CDC, which takes UK taxpayer money and puts it into emerging markets. At that time, it was quite a few emerging markets. Today, it's just Africa and South Asia. At that time, nobody was talking about impact investing, but one of CDC's most successful investments was the first really pan-African mobile operator. Today, that would be called super impactful, high-impact investing. Back then, it was just a good investment that was doing really good stuff for people. And if you think about, some of the things that have been really transformational in the lives of low-income people. Very few things come close to mobile telephony. So I've been sort of in this world now since 2004, 2005. It's just that people have told me that the world you're investing in is impact investing. I've kind of been doing the same thing since then. It's the nomenclature that has changed, and I think the discipline and the deliberateness with which we're making investments that has evolved significantly.
Okay. So the first thing to say is that my name's Stewart Langdon. I'm a partner at something called LeapFrog Investments. I've been working in and around India since 2008, just in case you're wondering what a Ferengi is doing on the stage telling you about your own country. And in fact, back then, in 2008, people used to call me up from the US or the UK, and maybe I'd be in rural India, and I'd say, I'm sorry, I can't hear you, the reception here is terrible. And now people call me from rural India, and I say, I'm really sorry, I'm in central London. The infrastructure in this country is hopeless. And that just shows you really the extensive change, particularly technological change in India in the time that I've been involved. My involvement in impact investing stretches back to really 2004, when I got involved with a company. I was working as an investment banker at the time, for Rothschild, and we got an information memorandum came in on a company called Celtel, which was a Sudanese mobile operator. And at that time, all I'd done until then was deals in the German broadband sector. I was a telecoms banker. And Celtel was this story, which I think, Samir, you would know very well, of how mobile telephony had been made affordable for Africans and really people in any low-income country, and as a result of that, access to mobility or mobile telephony had become available to everybody rather than just people in the West. And later, I got started at LeapFrog, which was an investment firm, and is an investment firm that wanted to think about how could we do that for everything else. If you could innovate and make mobile phones available to everybody in low-income countries, shouldn't we do the same for health insurance? Shouldn't we do the same for different forms of credit? Shouldn't healthcare and education also see the same pattern of innovation? And so I joined LeapFrog in 2010, and we've been at it ever since. Amazing.
I have to say, though, you'd be surprised how good Stewart's Hindi is. So don't take him for a Firangi, that much I can tell you. What I want to do is just sort of set the scene in terms of, for those who may not know enough about impact investing, how big is this sort of market, India, globally, any thoughts on that? What sectors or regions are sort of usually covered by impact investors like yourself? And where does India sort of fit into that broader matrix? Maybe this time we start with Samir and then Jyotsna, and then or if anybody wants to jump in, please feel free to.
Okay, I will leave Jyotsna on the numbers. I don't actually have the number in my mind. But I think first thing is that impact investing has a general feeling. People know what impact investing is, but different people have different definitions. So it's very difficult to say, this is impact investing, because I guess the quandary is, some people go into a really strong commercial business from an investor standpoint. The business is doing really impactful stuff, making good returns, and that is highly impactful. So I guess the question is also, which perspective are you looking at? Are you looking at it from the perspective of what is the goods and services that the company is delivering to whom, and is that impactful? Or are you looking at almost the color of the money? Is it coming in because it's impactful? I think impact investing started off probably mostly addressing social issues. So, microfinance, bringing finance to low-income populations, bringing the cost of financial services down. Healthcare, again, costs, bringing it down. So a lot of this bottom-of-pyramid sort of areas that people are interested in. I think then the whole climate juggernaut came. Today, people do club impact and climate together. And I think one of the questions is, are we still making sure that there's enough capital available for the societal, social needs, because those are becoming more and more pressing, while allocating capital to climate as well, which is, particularly on a global scale, because climate is such an important issue for the sources of capital as well as the users of that capital, it is becoming almost a competing pool to impact investing. But both are clearly very, very needed. And in a country like India, the confluence of what's important from a climate standpoint and what's important from a societal standpoint, there is a significant chunk of the Venn diagram that overlaps, which I think is the area that is probably going to see a lot more development now.
No, absolutely. Thanks for that. Jyotsna, any thoughts?
Well, it's a multi-trillion-dollar question, I guess, as to what the size is. Maybe if I were to double-click on, and we actually picked up this question some time back and commissioned a study to try and identify how large this market is. And honestly, when you look at this customer segment, there's a lot of disservice when you try and measure it by disposable income or discretionary spends, because that's just the tip of the iceberg. A family that spends on their education, on healthcare, etc., is netted off from income. You may not have a lot of discretionary spends, but that doesn't mean that family is not spending, is not key to economic activity in the country, right? So when we commissioned the report, we looked at even measuring the number of people in the segment is tough. So we just said, let's look at families that have a pakka roof, which is a permanent roof on their heads. And let's, at the other end of the spectrum, look at people who don't yet have access to credit cards, right? And we said, credit cards are probably the easiest unsecured access that people get. And after that, let's assume they have access to banking sector and everything formal. And you look at that segment in between, which is ready to commercially engage and yet does not have access to what is needed for their growth. That number looked like 247 million households in India, right? And that's a big chunk of the population. And the second measure we were trying to look at is, so now what? What about these 247 million households? And we said, we don't want to just look at discretionary spends because that's not the pocket we're trying to target. We're trying to target something which is core to the households on their transactions. When they spend on their businesses, when they earn money, when they're investing in high priority goods and services like healthcare and education, all of those become important transactions that are currently being addressed by an informal market, not adequately addressed in terms of quality of services, and something that the market is ready for their own growth, right? I would almost say the largest migration in the world is probably a socio-economic one, and it's intergenerational. And that number in a market like India for 2023 was $8.8 trillion of transactions, something that is very capable of formal brands and trusted brands and businesses being set up to cater to. So that's just one data point, and I'm sure we can find many others. But I'll leave Stewart to talk a bit more on how climate also fits in. It's a big part for this population, right?
Very, very big part. I guess it's interesting when you ask how big the impact investing market is. I think very often you get asked that in the US, and in the US, impact investing I think is seen as being a niche, you could say. So there's some people that are interested in social housing and stuff like that. In my view, impact investing in India would be most of what needs to get done to build the country over the next 20 years. I mean, I think of India as pretty much an impact economy. If you think that today, 3/4 of people don't have health insurance, somewhere between 2 million and 3 million people every year die from, treatable conditions. If you think about access to education, if you think about India as one of the most exposed countries in the world in terms of climate change and the third largest emitter, and you think about all the work that needs to go into the energy transition, all of those things are really important parts of what the private sector needs to do over the next 20 years in India, and yet are really impactful activities. So the way I would think about it, or the way I would encourage everybody to think about impact investing, is not as kind of some weird sort of side project of private equity, but rather absolutely, a key mainstream activity that's going to be so important in India the next couple of decades. I think the climate piece, which Jyotsna asked about specifically, is kind of interesting here. I mean, for all Britain's shortcomings, we're sitting in a country right now where emissions have fallen by more than 50%, first country to do that. We're at a point now where 2/3 of emissions come from Asia, Africa, Latin America. So the historic story, I think, has been about the West and how does the West decarbonize. And of course, The history of climate change, of course, is that the West created the problem. Nobody disputes that, but the problem is we all need to act on it. And so the story is now becoming, how do countries like India, which has about 7% of global emissions, how does India decarbonize? And what I think we need to do, and what organizations like Elevar and BII and LeapFrog need to do, is make sure that more dollars in the world go towards decarbonizing Asia and Africa, particularly India, rather than just the West. And if you look at it at the moment, that is not what's happening. The vast majority of investment in sustainability is going on in Western markets, who at this point are not primarily responsible for the rise in emissions. So there's a lot to do.
Absolutely, and the way somebody put it to me recently is that the opportunity in India is essentially infinite. It's such a big market, right? And in that context, like you mentioned, Stewart, that it's a big opportunity there. It probably includes everything that needs to get done in India for the next 20 years. In that context, when the opportunity is so big, how do you sort of go on deciding where are you going to deploy your capital? What sort of companies are you going to choose that sort of look after your financial returns, but also maximize the impact that you're obviously after when you're looking at companies? And perhaps just for the audience context, what would also be helpful is if you could just sort of tell us with a company or two that you've invested in that you feel particularly proud of, and why is that? That'd be super helpful. Maybe we start with Stewart this time and then we go around the table.
Okay, so a couple of things. I mean, the first thing to say is we're a for-profit. Sometimes people think impact investing can be a not-for-profit activity. We're a for-profit activity, so we like to find companies that are growing very fast, are either already profitable or they're coming into profitability. For us, what people like to call theory of change, which in a lot of places sounds a bit too kind of intellectual, but in the Cambridge Union, I guess you can get away with these sorts of terms. We're very specific. We like companies that are playing a big role in defeating either poverty or climate change. And we measure that in the millions of low-income people that these companies reach. And we measure that every quarter with the same rigor that we measure financial performance. So our slogan or our strapline is profit with purpose, and the criteria we invest behind are broadly aligned with that. So fast growth and reaching large numbers of people. And that last point about scale, by the way, I think that's really important, because there are still many people involved in impact investing, including a lot of really impressive projects and companies that focus on, 1,000 people or 10,000 people. And that is really important, noble work at times, but it's not of a scale that's going to make a real difference in a country the size of India, and that's what we want to do. In terms of pride, I mean, we invest in healthcare, climate, and financial inclusion, basically the three. We just exited our shareholding in FinCare, which is a microfinance entity that provides loans to about 3.5 million women. So that, if you think about the size of those women's families, that's one that is something we're particularly proud of. On the insurance side, we invested actually alongside the Mahindra Group in their insurance brokerage and designed a health insurance policy that got to about 2 million customers in rural India. And then most recently, we just invested last week in Battery Smart, which is the #1 player in battery swapping in India. From a climate perspective, that's one that we're excited about now.
Amazing.
Yeah, sure. So, I mean, just in terms of context, we've got the luxury of actually investing across different financial products. We can invest in equity, we can do debt, we can do guarantees, we can do VCs, we can do funds, we can do quite a lot, which means that luckily for us, there isn't a one-size-fits-all. What we do need to do is make sure that we're disciplined around what we do. So it has to have some link to the SDGs. There has to be a very clear rationale around the pathways of impact that we're creating, the beneficiaries, the scale of the impact, and then what is our differential role. And so we do this ex ante and then make sure that we're following it ex post. So if it is number of jobs created, we have an estimate on what it is ex ante and then track it as we go along, or emissions reduced. So one space that we've spent a lot of time on for the last 5 years is around this whole EV space in India, because we sort of figured, look, India has 22 of the 30 most polluted countries in the world. huge amount of tailpipe emissions. If we can bring that down, that would be great. So we started looking at the entire value chain and saying, which product can we match to which node in the value chain? And some are much riskier than others. So today we have a portfolio of a bunch of different investments, some in debt. So we've got an investment in Everest, which is a fleet operator. We have an investment in Battery Smart, a couple of these much smaller businesses, but through our fund investments. And then we said, okay, where should we play a role? Where should we directly come into equity? And we thought, well, in the automotive space, if we can make a dent in the largest polluting element of it, that would be great. Now, the largest polluting element is in SUVs. So we came across the Mahindra Group, who we've had a relationship with for the last 25 years. We know them very well, and said, look, we would love to find something to do with you, but just on your EV side. And those conversations led to us and Mahindra spinning out the EV business into a new co. We've committed $250 million to it. That's a huge investment for anyone, definitely for us. And the idea is for this unit to start launching SUVs. And if you think about what SUVs have done, going from sort of 20% of the market, way back to probably north of 55% today, we feel really good that if this business is going to take off, we can actually make a really strong impact in the market around emissions. So it just gives you a little bit of a thought process around how we operate, but also obviously the advantage of having multiple bets across multiple points of the value chain just get you smarter and smarter about where you want to make your next bet, whether it's in localization of cells, whether it's battery recycling, all those sorts of interesting spaces.
So just as a little bit of context for the audience, when you raise a fund, there's a 10 to 12-year horizon that you look at, right? And unlike most businesses, you don't have a choice to pivot 3 years out on what the fund plans to do. So you have to be fairly clear about what your worldview is going out 10 plus years, because by the time you're exiting investment, someone else has to be excited to buy your portfolio, and that's how a fund makes returns. So you're kind of trying to looking out 15 years at least and trying to see what the world's going to look like. So as far as Elevar is concerned, we actually go in fairly early. We like being the first institutional capital on companies that are starting out to lay the DNA for businesses that lie at the intersection of what creates shareholder value as well as customer value. Mm-hmm. And I actually think that alignment is what defines an impact investor, if at all, because incidentally, for all the money that we've invested, close to 10x more money has flowed into our portfolio companies, and 75-80% of that is pure commercial capital. I think what differentiates us probably is our specialization on understanding this customer segment and knowing how to build the DNA of these businesses. And that's what's exciting, because that's the DNA you follow through for the next 10, 15 years. So as a result today, if I think of, it's tough to pick investments that are favorites, but something that's close to my heart obviously is education. So Lead School is a business that we invested in when there were 5 schools on the ground. They now take care of education across 9,000 schools by taking care of ensuring that the quality of education is upgraded for K-12 in these schools through a school-in-a-box solution. And they're doing really well. We're big believers in unit economics, and therefore, even though we go in very early, we're not looking at binary risk businesses. And I actually think it's great not to have a too intense strategy of what works, because there's a lot of effort that goes into building out these businesses. On the agriculture side, which is again considered a fairly critical aspect of this customer segment, we have an investment in Samunati that is looking to rebalance the power dynamics across the supply chain. Typically, the weaker players have very little negotiation power, and incidentally, our thesis on agriculture came from interesting conversations on the ground when we were making visits into rural India, where we picked up how strongly farmers felt that they were producers and not traders. And that was a very important business insight, to not try and force a trading solution onto a farmer who is really good at producing what they produce, right? So there are nuances in these businesses that play out over 10, 15 years only if you really understand the segment well. Yeah.
Amazing. No, that's super helpful. What I will say is that other portfolio companies are listening in, and they may or may not be happy about not being on the favorite list today. But jokes aside, you picked on a couple of very interesting observations there, Jyotsna. One is that you need to be close to the customer. and the other is that there's a lot of commercial capital flowing in. I'll come to the commercial capital in a bit, but let's talk about the customer. LeapFrog is obviously a flagship fund, sort of focuses the emerging market consumers, and that sort of seems to be a common thread with all three, BII, Elevar, and LeapFrog. There's a lot spoken about the Indian consumer and how aspirational the Indian consumer has become in the last 15, 20 odd years. My question to you is, now that you've been investing in these markets for a long time, how have you seen your consumers evolve, the end consumers, not the portfolio companies? And two, how have your investments evolved to match that sort of aspirational level of the Indian consumer? Leave it open to the house where you want to start.
Well, I mean, I can have a first stab. The very obvious point, I suppose, has been, I mean, when I started 2008, people had kind of 2G Nokia phones, but it was pretty hard to offer any kind of high-quality, rich customer experience over those kinds of devices. And then I fast forward to today, I think smartphone penetration is over 70%. 5G, as I mentioned, now covers more than half the country, which is going to be really important, I think, in the age of AI and all of that stuff that's coming down the pipe. Obviously, UPI has come in. It's funny to talk about. I mean, UPI seems so ubiquitous now. Maybe there are people here who may not know that UPI once didn't exist, Aadhaar once didn't exist. All of this change has happened on the technology side, and we've had to get better and better at investing in technology businesses, so fintechs and health techs and stuff like that. And even when we've invested in traditional businesses, insurance companies and banks and so on, really we've had to be pretty good at helping them to digitize if we wanted to maximize our return. I think we're coming into another phase like that. I don't want to be the sort of dinner party bore who goes on about AI is the next big thing, because I'm sure you've all met plenty of people like that. But I do think that's another big fundamental change that will shift the goalposts again. But nonetheless, despite all of that progress in India, I mean, you were talking about how the emerging consumers have evolved in that time. The reality in India is that inequality has generally got worse rather than better, even with all of the progress that has been made in the fight against poverty. And therefore, there's still much, much more to do. Still, half the country lives on less than $3 a day. As I said earlier, 3/4 of people no health insurance, right? So even with all the progress we've made in extending the reach of health insurance to all of those additional people the last 10 years, there's still a huge amount more to do. And that's kind of the joy and the frustration of India, that you can have a huge amount of social impact, and there's still a massive number of people that require access to education, energy, healthcare, all the things. So huge amount of progress, a huge amount of technological change, but still an enormous amount still to do, I think.
Absolutely. Jyotsna?
I'll probably take a slightly different lens. Again, if I go back to the woman I met in Jhansi, at that point she had 5 children, and in my naivety I asked her why she ended up having so many children, and she said, my mother said that some of them won't survive, so have as many children as possible. And she was struggling to make ends meet and educate the children, etc. 20 years forward, what's really interesting is those families, the children have grown up, and they all have multiple sources of income. A typical rural family today has income from agriculture. It has income from some form of dairy, cattle. They typically have a small shop somewhere. One child has gone to the city to work, has a salaried income. Sometimes somebody is on pension or is renting out something. Those 4 to 5 sources of income have been fascinating to watch evolve, because what that means is that irrespective of what's happening in the external environment, these households have found ways to de-risk themselves from external shocks. It was beautiful to see that play out through COVID, through several other phases in the market over the last 20 years. And that shift is fascinating to watch. And second, very interesting observation is the role of women on the ground. I'm very often asked about the role of women in investing, etc. Actually, I find that topic less interesting. What I find really inspiring is how women are evolving on the ground. The amount of voice women have in decision-making within these households is very different from the workforce participation statistics that are published in research papers. I spend close to 10 to 15% of my time traveling across the length and breadth of the country into small town cities, districts, etc. And what I see on the ground is It's fascinating. You ask people, what does your wife do? They say kuch nahi, which is nothing. And you ask the woman what she does, she said kuch nahi, which is nothing. But then you start mapping out what they do through the day. The woman in the morning is very often taking care of the cattle in the house. After that, she spends time in the field. In the afternoon, she is manning the shop, and she's part of decision making. She decides where the children get educated and where money is spent and how savings are taken care of. And today, women walk up to me and say, you know what, we managed to save up a couple of lakhs at home. What do we do? What business can we start? How do we invest our time? We free up 3 hours of our day. That conversation is absolutely exciting, honestly. So that's the shift that I've seen from 99 to now. And honestly, that gives me a lot of hope and excitement for what we do.
Amazing.
So similar sort of themes. I think what Stewart said around everybody getting really excited about where India is going, but there are a ton of people in India that are not actually progressing in line with where the overall numbers are looking. So BII's focus in India is very much around climate and then actually serving these folks, those 300, 400 million, who are actually being overlooked by what's happening in India. Perfect example, we've invested in an affordable housing company where they work in tier 3, tier 4 India, and then their catchment areas are 60 kilometers radius around that tier 4. So those folks, this NBFC is the first time that anybody's ever even talking to them about credit. So it just gives you a sense of a lot of people being left behind. But I think there is another side of India, which is obviously aspiring, ambitious, doing well. Incomes are growing. We invest in a business that makes organic milk, exactly playing into these folks who are actually doing really well. That's not where we think the impact is. The impact's at the back end, where we're then working with small farmers who have 2, 3 heads of cattle and converting those businesses over 3 years into organic milk, so that those guys can then get sometimes a 50% to 80% uplift on their purchase price, because that's actually what we're selling the organic milk for. So you're playing into the progressive India, but benefiting folks who potentially would have been doing exactly the same old thing over and over again, and not having an improvement in livelihoods. This is doing exactly the opposite, benefiting those folks who are our primary focus.
No, that's super interesting. I am slightly short on time, so what I don't want to deprive the audience of the chance for Q&A. So maybe we jump into audience Q&A, and if we've got time at the end, I'm going to come back with my own questions, because the selfless man I am. Over there, please. Can we pass on the mic over there? Maybe we can just pass on this mic, if not. Is that possible, Sonia? Yeah, thank you.
Okay, my bad. My question is to Jyotsna and Stewart. Jyotsna, you mentioned alignment, right? So there is more and more awareness about impact investing. And so obviously there's more private market capital. How patient really is that capital now, right? So there are more players that are getting involved. Stewart, you mentioned for-profit. How do you really align those values in terms of the ROI, speaking to your investors, and also giving them the knowledge of it is going to be a long-term, impact-focused journey, and whether your values are also aligned with that, because obviously with maturity, you're also sort of, scared on the returns. My second question is just for the panel. What do you guys think of blended finance as an instrument? There's a lot of rise in that. Obviously, a push from IFC and World Bank towards it. So what are your views on that? Thank you so much.
Right. So lots of important points there. I mean, I think the first thing to say is that I am a believer that you can build big businesses on a completely commercial basis in India that seek to address some of the country's challenges, also the world's challenges. I believe that you can build big microfinance businesses, big health insurance companies, big EV companies involved in the transition to net zero, and that actually, you don't need to compromise in terms of commercial discipline. And what we've always found at LeapFrog, we're at a point now where we'd be about 20,000 crores roughly under management, if my 83 times table is correct. And the reason we've been able to scale to that level is because we've been able to go to private capital markets and tell them that we can grow businesses of that kind of scale on a completely commercial basis. The minute you start to say to people, well, it's social impact, so you'll have to wait longer for your return, or you'll have to give something, that's when actually we find it's really difficult to scale our funds. And we've been very fortunate that the businesses that we've found and that we've invested in have been aligned with what we want to do. I find particularly in India, there are many, many promoters, maybe because of the history of the country, the ethos of the country, many, many promoters who like the idea of impact being at the heart of their business. And I think if I can just say two things. One is your choice of promoter that you invest behind matters a lot. So we've been very lucky. Our first investment was in Shriram Capital down in Chennai with RT, who you might know is a sort of famous promoter down there, and then with Anand Mahindra, who at the time was rebranding his business as Rise, the Mahindra Group Rise, because he wanted all of the Mahindra Group's activities to be about the rise of the Aam Aadmi, which is a kind of, if you like, a sort of social impact orientation. So I think you need to choose your promoters pretty carefully, which we do. And then secondly, I mean, hopefully over a period of time, you get pretty good at spotting the good guys from the bad guys. You know, if you're investing in a microfinance entity, you can have a look at the interest rates. You can figure out if people are, engaged in price gouging or overcharging customers. You can have a look at collection practices. You can figure out pretty quickly if this is a business with the right social impact ethos around how customers should be treated, or whether it's a loan shark, if you like, which is a real risk. So hopefully over time you get better and better at spotting some of these things, but only really by choosing the right promoters and doing the right diligence around social matters. I think you can manage it.
I'll just add 2 quick points. One is, I think this customer is willing to pay full price. I don't see why anyone else up the chain needs to compromise on anything. So to that extent, this divide is not quite necessary. I think the point on patient capital is, I think it's just a different investment philosophy. It's not exclusive to the impact world. Your thesis could be to invest in something that's completely disruptive, which is also impatient, or you could just invest in themes that actually build long-term compounding value, and that's true of many industries. It's not just restricted to the impact space. So I think if you're choosing your thesis right, where you're investing in what customers are anyway spending on and formalizing those businesses like healthcare, education, financial services, agriculture, there are regular businesses to be built and there's regular returns to be made. It's just that you need to know how to align the business model and the stakeholders.
Let me maybe pick up the question on blended finance, because that's something that we are thinking about a lot. It sounds really cool. It sounds like it should be dragging in trillions of dollars, but it's really tough to implement. And for folks who aren't familiar with it, this is the concept of saying, how do you take more commercial money from the West, from Europe, from the US, where there's trillions of assets under management, and bring some of that to all of these impactful causes in emerging markets? And what can sort of governmental, quasi-governmental entities do to drag that capital in? I think we're still in very early days, because each source of that concessional capital today comes with its own bells and whistles. It comes with its own loss absorption appetite. It comes with its own other, expectations around it. And that challenge of trying to balance, so to speak, the multiplier effect, that look, you're taking $1 of my concessional capital, you need to bring $10 of commercial money. Is 10 the right number? Is 6 the right number? Is 5 the right number? That's question one. Question two is, am I supposed to be giving you grant money, or are you actually giving me something back? And how much return should I be expecting? Is it basically like an LBO structure, where I'm basically giving you, sort of very expensive money, but after everybody else gets paid? Or am I actually giving you money that is, lower return and loss absorbing? And I think there's a long continuum of people who are playing in this space, and I don't think there's any standardization. The final point to mention is that this blended finance, unfortunately, is all being directed towards climate. And I think coming back to what I was saying before, it's the social needs that aren't today able to let's say, capture as much of this blended finance, which is a shame. We need to figure out a way to do that.
Thanks for that. We have time for one more question, and we'll have to keep it rather quick. I'm sorry about that. Perhaps we go to the gentleman over here. Yeah.
Thank you for the wonderful panel. So I'm Venkata Gandikota. I'm a visiting fellow at the Judge Business School with Jaideep and India Center. So I'm doing a climate finance white paper, and I would like to talk with all three of you separately. So one thing that I have noticed is the limited partners in Europe. I want to ask of you, are the limited partners in Europe nudging from impact funds or putting money into impact funds to climate funds? Because in impact funds, you measure the social impact KPIs. In climate finance, you don't need to measure it, the social impact KPIs. What's your take on that?
Maybe we start with Samir, just because...
I mean, as it's an LP question, probably best for them.
Okay, please.
Well, look, I would say over time there has been, I don't know if this answers your question, I'll do my best. I think there has been a shift from people taking an interest in poverty to people taking more of an interest in climate. So I would say LP dollars, in my mind, or euros, have very much shifted from poverty to climate. If you can do both, then that's even better. But really, the climate is the flavour of the day. We're just in the middle of raising a new climate fund, which has LP money coming into it from Europe, but also from the US, and increasingly actually from Asia. So Temasek, for example, are a big investor in LeapFrog, but also we see the Japanese, the Koreans, these kinds of countries, more and more LP money flowing into impact investing even from there. But I think the answer to your question is it's more and more about climate. There is one caveat to that, however, which is that there are many businesses now that are about both. So if I think about something like the EV market in India, and in particular, what's interesting, in India, the shift to electric vehicles is very bottom-up, right? In the UK, it's top-down, rich people getting Teslas. In India, it's low-income people getting electric two-wheelers. Now, if a lower-income guy gets his first two-wheeler, and it's an electric vehicle rather than a combustion engine, then that is both financial inclusion, typically, because normally you have to lend money to the guy to allow him to buy it, or the woman, as well as a climate-related investment. So increasingly, a lot of the time I used to think of social impact and climate as being separate things, but increasingly I find, you go and meet a climate business and it turns out there's a big financial inclusion angle as well.
And actually that financial inclusion angle needs a specialization. So just cracking the climate technology doesn't help, because you need to figure out distribution and trust with the billion-plus people who need to subscribe to that change.
All right. I'm sorry, but we cannot entertain any more questions at the minute. But with that, we'll close the panel. Please join me in thanking the panelists here. They've been incredibly kind, giving us their time.